Ladies and gentlemen, good day and welcome to the Balkrishna Industries Limited Q4 FY22 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Basudev Banerjee. Thank you and over to you, sir.
Thanks, Mike. Very good morning to all the participants. And thanks to Balkrishna Industries management for giving us the opportunity to host the call. We have with us Mr. Rajiv Poddar, Joint Managing Director of Balkrishna Industries and Senior Management of the company. Over to you, Mr. Poddar, for your initial comments, sir.
Thank you, Basudev. So good morning, everyone, and thank you for joining us today. Hope all of you, along with your near and dear ones, are safe and healthy. Along with me, I have Mr. Bajaj, President Commercial and CFO, and also SGA, our Investor Relation Advisors. Let me begin with performance updates. The geopolitical situation has aggravated supply chain problems. This has increased both the prices and availability of raw materials. Similarly, logistics and freight costs have continued to remain at elevated levels. End-user markets continue to remain strong in spite of inflationary trends. The off-highway tire industry continues to see higher offtake on account of healthy demand across mining and agricultural markets, and the BKT brand continues to gain market share. Let me now talk about our CapEx plan. During the quarter, we commissioned the 50,000 metric ton per annum brownfield tire plant at Bhuj. We expect complete ramp up in production to be achieved in second half of financial year 23. Carbon black, the project is on track. We expect the commissioning of the 55,000 metric ton per annum carbon black project along with the power plant in the next 2-3 months. The advanced carbon black project of 30,000 metric ton per annum will be commissioned in second half of financial year 23. In November 21, the board had decided capex at the old Waluj plant at a cost of 350 crore. For simplicity, we will term the old plant as Waluj 1. However, the board of directors have now decided to keep this capex investment on hold and continue the operations of the plant in order to have unhindered production and cater to the strong demand and quicker production schedule demanded by end customer. As you are aware, the new plant in Waluj, now termed as Waluj 2, was commissioned in September 21, which has a capacity of 30,000 metric ton per annum. The total achievable capacity profile is 360,000 metric ton per annum, which will be available by end of financial year 23. The board of directors has declared a final dividend of rupees 4 per share in addition to the 3 interim dividends of rupees 4 per share each and a special dividend of rupees 12 per share announced earlier in financial year 22. Thus, the total dividend will be rupees 28 per share. With this, I now move on to the operational highlights. Our sales volume for the quarter was 77,119 metric ton, a growth of 13% year-on-year. For financial year 22, sales volume stood at 288,795 metric ton, registering a growth of 27% year-on-year. Our standalone revenue for the quarter stood at 2,432 crores, which includes realized gain on foreign exchange pertaining to 58 crores. For financial year 22, revenue stood at 8419 crore, which includes realized gain on foreign exchange pertaining to the sales of 152 crore. For financial year 22, 54% of sales came from Europe, 18% from India, 17% from Americas, and the balance from rest of the world. In terms of channel contribution, 69% was contributed from the replacement segment in financial year 22, while OEM contributed to 28% with the balance coming from offtake. In terms of category, agricultural segment contributed 66% in the financial year 22, while OTR, industrial and construction contributed to 31%, and the balance came from other segments. The standalone EBITDA for the quarter was at 576 crores with a margin of 23.7%. The EBITDA for the quarter was impacted by higher logistic costs, which has moved up almost 400 basis points quarter-on-quarter basis. In addition to this, we also saw higher power costs. For financial year, EBITDA stood at 2182 crores with a margin of 25.9%. Other income for the quarter stood at 52 crore, while unrealized loss stood at 21 crore. For financial year 22, other income stood at 185 crore, while unrealized gain stood at 39 crore. Coming to the net forex item, for the quarter, we had a net forex gain of rupees 56 crore, which includes realized gain of 77 crore and unrealized loss of 21 crore. For the financial year 22, we had a net forex gain of 246 crore, which includes realized gain of 207 crore and unrealized gain of 39 crore. Profit after tax stood for the quarter was recorded at 374 crores, while for the financial year 22, profit after tax stood at 1411 crores. The financial year 22 profit after tax was impacted by the crystallization of contingent liability to the tune of rupees 65.4 crores, post completion of certain tax assessment which was charged in the Q1 and Q2 of the financial year. Our gross debt stood at 2443 crores at the end of 31st March 22, of which about 1942 crore is relating to working capital debt. Our cash and cash equivalent were at 1932 crores. For financial year 22, we incurred a total capex of 1023 crores on new capex programs of the allocated 1900 crore project. For Q4 financial year 22, the euro hedge rate was at rupees 86.5. Forward hedge rate currently stands at around 85 levels. For financial year 23, we expect to clock volumes of 320,000 metric ton to 330,000 metric ton, considering that capacity enhancements from ongoing capex will be available towards the end of first half of the financial year. With this, I conclude my opening remarks and leave the floor open for Q&A. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants are requested to please restrict your questions to 2 per participant. Participants are requested to please restrict your questions to 2 per participant. We have the first question from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, sir. Congrats on good numbers. Firstly, you mentioned the hedge rate was how much for the quarter, the realized rate?
86.5.
86.5 and 85 will go to subsequently.
Yes.
Secondly, on this Vadis plant, we had mentioned earlier that this plant can't be used. So is it like the plant machine is still usable, or we will incur that capex later on?
So at the moment it is usable, and since there is a strong demand, we are continuing to use it, and we will decide once at a later date about how to go about the planned investment.
So in that case, what is the capex number for 23 and 24 is being provided?
Roughly 900 crores.
Okay, 900 crores capex.
Yeah, the 1900 is the total project. I think we have done roughly just over 1000. So the balance will come. It's roughly 900 crore for next year.
And lastly, if I may ask, any color on, like, demand is strong, any color on the inventory, the distribution channels and all? Is that normal where it stands today?
Yeah, it is normal as per what it was standing. It's normal.
Around 3 months or so?
Yes, yes.
Okay. Thank you, sir.
Thank you. We have the next question from the line of Siddhartha Bera from Nomura. Please go ahead.
Yes, sir. Thanks for the opportunity. Sir, my first question is on the freight cost. So even if I look at quarter-on-quarter on a per ton basis, it is jumped sharply by about 50%. And if you look at the freight indexes and all, it has not jumped that sharply. So, I mean, is it also a factor of availability, and why is it jumped so sharply? And if you can just highlight about the outlook, should we expect these type of per ton levels to continue, or do you expect that there is some dip in the current quarter?
So basically, we had some old contracts which were running in the earlier part of the year. That's why you didn't see the impact so sharply earlier. They came and we have to renegotiate the contracts which were negotiated at the current rates, which led to this kind of impact. So that is where the full cost is now, the full picture is now captured into the costing because the new contracts have come in place.
And same is likely to continue for some more period. Current rates are likely to stay. We don't foresee any immediate relief in the freight.
Acha, got it. And second is, sir, on the demand side now, if you look at the capacity, we will already be touching close to the peak capacity in the second half on a quarterly run rate basis. So what is the plan for next year? Given the current capacity, I think the next year growth will be at probably low single digits at full capacity. So any plans on the capacity side, how you are looking to expand from here on going ahead?
So we've put the team is on the drawing board. The whole team is working on the drawing board. As soon as we have something more specific, we will come to the board, and once the board approves, we will announce it. But we are on the drawing board phase for future expansion.
But generally, by the time you plan it, how long will it take for the capacity to come on stream?
Between 18 to 24 months.
18 to 24 months. Okay. The last question is on the working capital side. We have seen a very sharp jump this year, specifically on the inventory and all. So next year, how do you expect this? Should we expect a similar level of working capital, or you believe that it may come down?
No, basically working capital will remain at these levels. See, there are three reasons which have contributed to that. One is the overall turnover of the company has grown. Number two, the lead times have grown because of the higher shipping periods and availability, so that realization of the money is going to take that period. And thirdly, the raw material cost has also gone up, which is leading to higher purchase price. So all the three combinations coming together has had an impact on the working capital, which we do not see a major relief on that. So we expect it to be at these levels.
Okay, got it. I'll come back in that queue for follow-up.
Thank you.
Thank you. We have the next question from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. Can you talk about the price increases taken fourth quarter and in 1Q so far?
So fourth quarter, we had taken a price increase towards the end of February, beginning of March, and that was to the tune of 2 to 3%. And we are planning to take another price increase in June to the extent of 3 to 4%.
Okay. So in that context, what has led to the 7% QOQ increase in blended realization in fourth quarter?
So basically, whatever price increase we had taken in Q3, the full impact of that is come in Q4.
Okay. And what was the carbon black sales for fourth quarter and FY22, the external sales?
So overall,
Less than 3%.
For both fourth quarter and full year?
yes.
Okay. And lastly, with respect to the underlying demand environment, in case of this tightening of interest rates and money supply plays out and the commodity prices cool off, do you expect demand also to moderate from where we are for our product, or in the past we haven't seen much correlation?
At this stage, we see a good demand, and what we are what we are hearing is that it should remain strong for the near future. So we would like to maintain that.
Okay, thanks. I'll fall back in queue.
Thank you.
Thank you. We have the next question from the line of Ronak Sarda from Systematics. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, firstly on the some of the financial numbers, if you can highlight what was the quarter four cost of key raw materials, natural rubber, synthetic rubber, and the others.
Natural rubber was around 150 rupees a kg. Carbon was around 98 to 100 rupees a kg. And fabric approximately 375 rupees a kg.
Okay. And now our carbon black consumption is largely from the captive usage or still buying from outside?
No, 100% from captive usage.
Now 100% captive. Okay, great. Okay. So just a follow-up here. I think the domestic tire manufacturers, other than yourselves, the raw material for natural rubber, the natural rubber price has already increased up to 180 and beyond. So can you explain what's helping us in this scenario?
Currently, natural rubber prices are around 165 to 170, 72 levels. Earlier it was 180 also, as you are telling. So now in last 10-15 days it has gone, and we are hopeful that now it should continue in the current levels for next couple of months.
No, right. That's understandable. But for us, you think 150 was the average natural rubber price?
That price is including custom duty, etc. Our price, because majority is export, so our price will be in tonne per kg will be always lesser.
Got it. Second, more your thoughts on the treasury management. For the last 3 years, we have seen cash balances increasing and even short-term borrowings being at a very elevated level. In this year, we have seen now long-term borrowings also coming through. So we are overall in a net debt position. So how do you see this? Both gross debt and a high amount of cash. Was the thought process there?
So ultimately, we will use the money for capex. So that is what the plan is.
Right. But I mean, we are already on almost 98 crores of cash. I don't think that the large capex plan coming through.
So if you see, the debt cost is about 0.5%. So it's within the thing. So having the treasury and having the debt is not. There is a certain arbitrage. There is that difference between.
That debt cost continues to remain at such a low level right now?
Yes.
Okay, sure. And finally, follow up on the inventory side. We understand the increase in the cost, but if we calculate on number of days, it has gone beyond 75 days in the current year, which has largely been below in that 50 days range. So what would explain that, given we are short on capacity? Or is this Is there some one-off item here in this?
No. Basically, if you see the availability of raw materials has an impact, so you have to procure and keep. Secondly, availability on outward shipment is also an issue. So, that is also adding. So, it's a combination of both these things which have added to these things. So, as it cools off, as availability of containers eases out and all, you will see this drop back again to those levels. But till then, it will sustain at these levels.
Okay. Got it. Okay. Thank you.
Thank you. We have the next question from the line of Ankit Anodia from Smart Sync Services. Please go ahead.
Thank you for taking my question. My first question is regarding the difference in, as in if you compare the FY21 numbers and FY22 numbers. So in volume terms, what we see is that earlier our share from India market was around 22, 23, which has come down to 17%. And correspondingly, we have seen a rise in the share of Europe. So is it a mix of Europe doing well and in India you are seeing demand, or what is the scenario? Can you just throw some light?
So there were two issues which have impacted this. One, there was a very strong demand from Europe. So we have, in the export market. And secondly, in the first half of this, there was also COVID impact in India with certain shutdowns and other issues which have impacted. So there is no other, nothing else which has impacted this.
So the demand remains strong even in India. And what is about, and how are we placed in terms of our distribution reach in India? Is it expanding compared to last?
Yeah, we have a pan-India distribution network.
Okay. One last question was regarding your, in one of your focus areas you mentioned in your presentation is penetrate America. But when we see the volume share, it remains almost at the same level what it was in the last year. So what are we actually doing, and what are our plans for say coming year or in the future to increase that share?
So no, if you see the actual numbers of dispatches in percentage terms, it remains same. But you're talking of a higher percentage of a higher number, no? So if you see the growth in America has been substantial in the last 2 years. But percentage-wise, it remains same because our base has also grown, no? So what base you are comparing 250 versus 280, 290. So that base ka 17% is there. So if you see the actual number, it has grown.
Okay.
In tonnage terms, there's a substantial increase.
Right. And anything else as in any particular strategy which we are following there in America? If you would like to throw some light on that, what we are doing.
Following the what strategy we had put in place a couple of years back, we are seeing the benefit of that, and we would like to continue with the same strategy.
Okay. Thank you. Thank you so much.
Thank you. We have the next question from the line of Ameen Pirani from JP Morgan. Please go ahead.
Yes. Hi, sir. Thanks for the opportunity. So I just wanted to, get some more understanding on the non-commodity cost inflation. You talked about freight costs and also power costs. So power cost has gone up for you because of the increase in power tariffs, or is it because there have been power shutdowns and you are having to use more backup and diesel gensets?
So it's a combination of all the things. So the power tariffs have also gone up, and where we have our own power plants and all, there the cost of coal and gas has also gone up. And in certain cases there were power cutouts as well from the government. So we had to run our DG sets, which led to a higher cost.
And sir, going forward, given that in this quarter that coal situation has become tougher, at least that's what we hear, are you facing more unplanned shutdowns? Like, does it impact production? Is what I'm trying to understand.
So we have a full backup. In fact, as I said in my opening speech, that the new power plant at Bhuj should also be operational in the next 2 to 3 months, which will have an additional benefit of availability to us for our Bhuj production. So that should ease off some of the cost of the power for us over there.
Okay. So availability should improve, but the coal price and coal availability will continue to be a problem as it is for everyone, right? Is that a fair thing to say?
Yeah, absolutely, you're fair.
Okay. Okay. Thank you, sir. Thanks a lot.
Thank you.
Thank you. We have the next question from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thanks for the opportunity, sir. Sir, manufacturing costs expected to increase in entire Europe because of the high energy and RM cost. How do you see the opportunity of increase in realization of your products?
So we are working on that, and that's why we are being able to pass on this kind of price increase, and also we are continuing to pass on the price increase because it is an increase for everybody, and more so for the players in the western part of the world.
And sir, because this ongoing war in Ukraine, many players have shut down their plant in the Ukraine and the Russia. So how do you see the benefits of it in your business?
So I think that benefit was, the demand for BKT branded product was anyway strong, so and continuing to grow. So that was continuing without the thing also. So I don't think there is any impact in that sense on the demand per se because of the war. But overall the demand has been strong anyway. So it's not because of the war that this is created. So with even post the war, we see the demand to remain strong.
I'm talking about the benefit in the realization because we have seen a sharp increase in the realization. So most probably it is because of the passing freight cost, but also we have taken the price hike in this quarter.
Yes, because we have been able to pass it on to the end user. We have been passing it on.
Ladies and gentlemen, we have the line for the management dropped in the conference. Please stay connected. We will have the management reconnect. Ladies and gentlemen, we have the management connected, so you may go ahead.
Yeah, sorry, the line got disconnected. Apologies for that. So yeah, as I was saying that the cost which has been passed on is the realization is increased because we are passing on the impact of the cost, and that is always been the case. It's not a matter of demand or supply.
Okay, sir. So what is the gap between your price and the competitor price right now?
12 to 15% from tier 1.
Okay, so there is a room for the increase the prices in the coming months.
Sorry?
So there is a room for the increase in the prices in the coming months for you.
So gap should remain at these levels. So that will continue.
Thank you, sir. That's all from my side.
Thank you. We have the next question from the line of Vimal Gohil from Union AMC. Please go ahead.
Yes, sir. Thank you for the opportunity. Sir, just a long-term industry question and what the relevance to PKT is. We've seen a strong demand environment for quite some time now. I think the last downtrend that we saw was in that harsh climatic conditions that we saw in Europe. Post that, the industry has been held up well so far. So, do you think there are some structural changes that have happened in the industry so that the growth has happened, or Is it that Balkrishna has continued to sort of take market share, and going forward, the inherent cyclicality of this industry will continue, but Balkrishna will continue to gain share?
So it's a mix of both. There has been strong demand as well, and also the growth of BKT brand. The marketing and the brand building equities exercise that we were doing is now paying off, and that's why we are able to create a stronger demand for the BKT branded product, which is resulted in the Balkrishna growing at a quicker pace than the market. That means we are taking market share.
But you do believe that this industry will continue to remain cyclical in nature?
Yes. Yes.
Got it. So secondly, on your margin outlook, the demand, given the fact that the costs have been volatile, do you have any? Do you want to comment on the margin outlook going forward in the context of the current cost environment?
So as we have always maintained, and I always said that our endeavor will be to maintain an EBIT of 28 to 30% on long-term sustainable basis. Do not look at it quarter on quarter or in each quarter by quarter, because that can fluctuate based on variable costs. However, our endeavor is to maintain an EBITDA margin of 28 to 30%, which will be on a long-term sustainable basis. That is, we've always said, and we hold that statement true even today on a long-term basis.
Right. So last question would be on also the increase in inventory that we are seeing. Some of the contribution would also have come from your carbon black plant ramping up. Would that be correct?
No, this is basically for other raw materials and shipping costs. Because of availability of containers, we have to plan and keep. So it's not a matter of carbon black or not. It's overall for the tire business.
Right. So you don't have any inventory that is being kept in the carbon black plant?
No, there is a nominal inventory because that is all mainly local. So there is no problem of shipping availability over there, both from a raw material perspective of the carbon black as well as the supply to the customers. So that is not an issue.
Got it, sir. Got it. Fair enough, sir. Thank you so much, and all the very best for FY23.
Thank you.
Thank you. We have the next question from the line of Arvind Sharma from Citibank. Please go ahead.
Yeah. Hello. Good morning, sir. Sir, first question on the capacity build-up. If you could just enumerate how it could build up from the current capacity. I think 285 was the last year. Since the Waluj 1 plant was expected to add around 25,000 metric tons, that is not coming, I believe. So how can you please explain the capacity build-up from here on?
So basically, Waluj, what we were trying to build up is yet continuing. We are not stopping to refurbish it. So the old plant will continue, and that is already being producing tires. So that will continue to produce. And our endeavor is with all the projects that we have taken. This year we will see it between 320 and 330 metric ton, and eventually by the end of it, we will be at 360,000 ton for the following financial year.
That 360 includes the 25,000 metric ton that we are planning to add.
Yes, but that is already running. So we are not stopping the plant which is running. That's why that production capacity will continue already in the system.
So I was under the impression that was an incremental to 25,000 tons. So sir, right now your capacity is 285 plus 55, right? That's the capacity right now?
So yes. So the 50 it is 285 plus 50, which will be there. The 50 is being ramped up, which will come in towards the full production will be coming towards the end of the second half of this year. End of this year. So in the second half, you will see the benefit of that 50,000 coming, and the 25, which is from Waluj, will continue. So we are not stopping that. So because there is a strong demand, we are not stopping that. So that system is already in the system, which will continue. So earlier we had planned to stop that, refurbish it, and then restart it. But now we are not stopping it. So that 25 it's already in the system and will continue.
Okay, fine. Thank you for that, sir. So second question, sorry I missed it, the gross and the net debt position and for FY22 end, and the balance sheet has now turned out to be net debt. Balkrishna used to be a net cash company. Any targets that you have going forward in terms of balance sheet health, specifically in terms of debt and cash?
So basically, I'll repeat my opening statement. Our gross debt stood at rupees 2443 crores at the end of 31st March 22, of which rupees 1942 is relating to working capital debt, and 500 is the long term towards the project, and our cash and cash equivalent is rupees 1932 crores.
Okay, so that 1942 crores is likely to draw down, hopefully, by this year.
Yes.
Fine, sir. Thank you. That's all from my end, sir. Thank you so much.
Thank you. We have the next question from the line of Lokesh Manik from Vallum Capital. Please go ahead.
Yes, good morning, Rajiv and team. My question was on the increase in the freight cost. So you mentioned that these are coming on with lag effects and renegotiation of new contracts. So just a question on that: do we have volume visibility in these contracts where we don't be exposed to risk of lower volumes and higher freight costs going forward if the customer reduces the volume offtake?
No, there is no volume linked bonus or anything linked to the costing contracts. It is a very simple contract that this is valid for this duration. It's not related that you will get some extra bonus or extra discount if you reach a certain milestone number of
if they reduce the volume offtake, would that then impact us? Or would the cost then go down proportionately?
No, that is on per container basis. So whatever I ship out on a per container basis, that is what will be charged.
Understood. Second was on the energy crisis in Europe. So are you seeing your competition face issues with production planning, and maybe some volume would have been diverted to us through market share gains? Are you seeing that benefit coming in?
So no, we are not able to comment on our competitors' status.
Fair enough. That's it from my side. Thank you so much.
Thank you. We have the next question from the line of Joseph George from IIFL. Please go ahead.
Thank you. I have two questions. One is on the hedges that you have for the euro for FY23. Could you tell us what percent of your FY23 expected euro revenues are hedged, and at what rate?
For full year, we expect average realization of 85.
85. And all of it is hedged at this point for FY23?
Almost. We are gradually revert. Almost 85 we expect for the full year.
All right. And what was the similar realization for the full year FY22?
FY22 was 87.3.
Understood. And sir, the second question that I had was in relation to your margin outlook. You mentioned that your long term is 20. But when you look at year, 23, given inflation, higher operating expenses, etc., do you feel you will be able to?
Mr. George, this is the operator here. If you could come closer to the mic, your voice is breaking up on the line.
Is it better now?
Yes, a bit better now.
All right. Okay. Let me go ahead. So the question was in relation to the margin guidance. You mentioned that your medium to long-term margin guidance is 28 to 30%. But when you look at FY23, given inflation, given higher operating expenses, etc., do you feel you'll be able to bucket yourself in that range, or will it be tough?
So there is our endeavor to be in that range. We are working towards that. But because of the volatile conditions outside of the cost, volatile variable cost movement is so volatile at the moment. It's difficult to comment for short term. But long term, definitely our endeavor is to be there in that bracket.
Okay. So in other words, compared to say what we have, compared to the margins what we have seen in 3Q and 4Q, which is around 24-25%, pressures, or do you think the worst in terms of margins is captured in what we have seen in the last couple of quarters?
It's difficult to say now because there is so much of volatility on the variable cost. But as you can see, we have always been trying to pass on as much as we can, and we are working towards the next price increase already planned for June. So that is what is under our control, and we are trying to do that. So quite hopeful that we work towards our goal of 28 to 30%.
Got it, sir. Thank you.
Thank you. We have the next question from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi. Good morning, and thanks for taking my question. So coming back to the logistics cost, right? So if I look at your Q3 commentary, you'd said that costs were higher than what we passed on, but it's coming down, and therefore we've not taken any further increases in Q4. And now you're saying that the freight cost has jumped by almost like 400 basis points QOQ. So just trying to understand, I mean, what changed, really speaking, right?
So that was the visibility we had during the call, and after that, the contracts which were getting over, we were negotiating, and those didn't come in place. So that expanded, the cost went up after the call, and that's why we had to take a call of price increase. Just after the call, also we took a price increase in February, March, and now we are taking another one. So it was a reaction on the cost that went up.
Right. And so what was the price increase in Feb, March or in Q4 that you've taken?
2 to 3%.
2 to 3%. And this is largely like a freight and surcharge sort of a thing, or this is like a overall price increase?
Overall price increase.
Okay. And so also on the power cost, like you mentioned, you have a new power plant coming up at Bhuj in 2 to 3 months. So could you just talk about, I mean, how much of the capacity will become, how much will be captively then sourced, and what sort of savings you will get?
So Bhuj will be fully captive through our power plant. We'll be feeding it on our own. The other plants will be yet dependent on the grid. So that is how it will be working.
And what is the size of this? How many megawatts is this?
20 megawatt.
And this is renewable or thermal?
So 20 megawatt is already there, and the new one will be additional 20 megawatt.
Okay. And this is coal-based or what is this?
Yes, coal-based.
Okay. And just last question was on Russia. I mean, would you have a sense of what percentage of like the European agri-market production of tires comes from Russia?
No, we don't have that number.
Okay, sure. Thank you so much.
Thank you. We have the next question from the line of Trilok from Diamond Asia. Please go ahead.
Yeah, hi. Good afternoon, sir. I just wanted to obviously hear your thoughts, particularly with regards to the demand, because we know that acceleration is there across the countries, but this cycle has been a pretty longer compared to the last cycle. So have you sort of, seen any impact on demands across segments, or do you think there is enough, the pricing is, despite so much high prices, the demand continues to, grow and stable? That's point one. And probably you can answer this. I can go to the next one.
So at the moment, we see the demand to continue to remain strong. We hope it continues, and we are quite confident that it will continue to remain strong.
So far, what you're trying to say is all the prices that you're trying to pass on is completely absorbed, and there is no visibility of any kind of volumes kind of moderating or stagnating.
No.
And when you alluded to the differential of sort of March, the pricing between you and competitors between 12 to 15% even now, Do you see that gap narrowing, or do you think it can go further because you guys are operating at a margins which is still much better than what the others are doing?
So no, we'll continue to keep the gap of 12%. That will be 12 to 15%. We'll continue to keep that gap.
Okay, and then this just to reconfirm, or the capacity that you are kind of expanded will start from October. Is that fair assumption to make?
Towards the end of first half of of this calendar financial year, and it will slowly ramp up, and you will see the impact of it full impact coming towards the second half of the financial year.
And how long typically it takes for the full ramp up of the new capacity?
3 to 6 months.
Understood. Okay. Thank you very much.
Thank you. We have the next question from the line of Chirag Shah from Edelweiss. Please go ahead.
Yeah, thanks for the opportunity. So my first question is on Europe side. Given the recent crisis that part of the world is going through, are there any production disruptions that you have come across in your from ground level, which can create an opportunity either in terms of pricing or higher volumes for you? Is there anything of that sort coming across?
No, not at this moment. We have not come across anything.
Okay. Second question is just a follow-up on the earlier one on this capacity ramp-up. So you are saying that the new plant capacity will start flowing from H2 onwards, right? Or it will start flowing from current quarter itself and full ramp-up will be in H2?
Correct. You are absolutely correct. It will come from this quarter and full ramp-up will be towards the end of next quarter, towards the middle of next quarter.
Okay. And so just a clarification, the price hikes that you indicated, so is it possible to indicate over last 12 months, what is the kind of price hikes that you would have taken and also your peer set? So have you maintained that 10 to 15% lower pricing?
I don't have the whole year's data in front of me at this stage.
But broadly, would it be around 10-12% or more, or it would be low on the lower end?
Roughly, we would have done about 15-16% for the whole year.
And I presume your peer set would have done slightly higher to maintain the price gap that you indicated.
The price gap was same and is continuing to remain same. I am assuming they have done similar price increases.
Similar pricing. Okay. Thank you very much. Knowledge.
Thank you.
Thank you. We have the next question from the line of Maitri Parekh from PI Square Investments. Please go ahead.
Yeah, I wanted to ask about the carbon black prices. That what's the difference between our captive cost that we have and if we source it from market? So how much is the additional profit that we have making on that?
So it is approximately 10%, 8 to 10%.
Okay, so that is the benefit that we are having right now of the carbon black. And one more question, that what will be our market share currently?
In
3%, less than 3% of our total turnover, so we hardly have any market share.
No, for carbon you are asking for?
Carbon.
No, for our overall product, tires.
So tires, sorry, can you repeat your question? We got a little confused.
About market share in India domestic, not for the carbon black, but for our product.
For the tire product, our market share would be about 4 to 5% in India.
Oh, okay.
For replacement market.
For replacement, okay.
In off-highway tire business, for the products that we make.
Yeah, okay. Thank you.
Thank you. We have the next question from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Thank you very much. Sir, my point is when we have so much debt and capex plan ahead, why you paying so much handsome dividend and why not preserve money for further expansion?
So I think that is, the prerogative of the board, and I think they'd taken a call to give this. So up your point to them, but we are comfortable. But even after this, our reserves and everything are comfortable. So I think they have decided, the board has taken a call to give the kind of dividend. Also, this year was our 60th year. We had a special dividend to celebrate our 60 years. So that may not continue for the years to come.
Okay. Thank you.
Thank you. We have the next question from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Sir, employee cost has declined on a quarter-on-quarter basis. Any reason? Because we are in inflationary scenario, ideally employee cost should increase. So this decline is any reason?
Sorry, we couldn't hear you, Ashutosh. What is on the decline?
Yeah, employee cost declined quarter-on-quarter from 97 to 90 crores. So any reason behind that?
Yeah. So basically, during in the preceding years, we were giving some additional incentives during COVID periods, which have now lapsed. So that is where the impact of that has come down.
So now it will sustain, or maybe they will increase next year, but this is normalized employee cost.
Yeah. Absolutely correct. Absolutely correct.
And sir, obviously our short-term debt cost has been lower because of we denominated in euro and all. But with the rising yield, will there be increase over there in terms of debt cost percentage?
Very marginal. Very marginal.
Okay. And lastly, on this hedge rate, you mentioned 85 is the hedge rate, the forward hedge rate right now. But I assume that will be covering only 50% of our sales, like what we mentioned earlier. Or is it the full cover? 85 is the full cover right now.
85 we are expecting for the full year because we have already covered it.
So we've covered substantial amount at these levels. So the overall average would be at this level only.
Okay, got it. Okay. Thank you, sir. That's all from my side.
Thank you.
Thank you. We have the next question from the line of Siddhartha Bera from Nomura. Please go ahead.
Yeah, thanks, sir, for the follow-up. Sir, just a quick clarification on the CapEx side. When you said 900 crore is the project CapEx for this year, what will be the maintenance CapEx?
It's in line, which we normally maintain about 200 crores, so that will continue.
So total will be about 1100 crores for the year, right?
Yes, absolutely correct. Broadly, 900 is what we have for our project cost and 200 is maintenance cost.
Got it. And so second question is on the commodity cost per ton side. For the current quarter, what will be the increase you are looking at on a per ton basis?
What was your question?
On the commodity basket overall per ton basis, what will be the cost inflation you are looking at for the current quarter?
Maybe around 3% we are expecting, 3 to 4% cost increase to us.
Got it. So 3 to 4% cost increase, and we have taken about similar number, but June only.
Yes, correct. Absolutely.
Got it. Thanks a lot.
Thank you. We have the next question from the line of Suraj Fatehchandani from Compound Everyday Capital. Please go ahead.
Hi, sir. I have two questions. So the first one is, what is our total carbon black capacity?
So our total carbon black capacity is 140,000 metric ton.
And how much of that are we using right now?
That is the nameplate. That is the nameplate. We will be able to achievable will be 115,000.
115,000. And how much of that are we using right now, as in percentage terms?
How much of that are we manufacturing? The full capacity.
Yes. How much of that is required as per current sales?
95%, more than 95% consuming ourselves.
So practically we are selling about 20% of our production to third party. Rest we are using in-house. Then that is for 100% of our requirement is coming in-house, which equates to 80% of this capacity.
Got it. And so secondly, sir, a broad number on how has our revenues or our CAGR growth been better than industry? So any number on that? Industry CAGR growth versus our CAGR growth?
It's by and large in line. We are a couple of points over.
Got it. Okay. Thank you.
Thank you. That was the last question. I now hand it over to the management for the closing comments.
Thank you. Thank you to everybody for coming on this call. We look forward to seeing you in the next quarter. Thank you.
Thank you.
Thank you very much. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.